Hey tax students, this is your teacher Roy with a video for chapter number 10. Chapter 10 and our last chapter of the semester, chapter 11, kind of go together where we're going to be discussing the sale of property that the taxpayer owns and calculating out any gain or loss. The actual taxation of the gain or loss will be covered in chapter 11. So really here in chapter 10, we'll just talk about the amount of the gain, calculating the gain or the loss, and not really how it's going to be taxed. So this is probably part one of three parts with this chapter 10 video, where we'll have here in part one an overview, and in part two we'll take a look at something called the adjusted basis of the property that we're selling or exchanging. And then in part three, we'll talk about certain situations where we have a gain, that the gain couldn't possibly be non-taxable or possibly postponed until there's a subsequent transaction. So let's talk about possibly the largest property that you own during your lifetime. And for most people, that's their personal residence. So here's your house, here's your home. Here's the front door with circular windows. And here in Hawaii, during those chilly 60-degree nights, you can use your fireplace. So let's turn on your chimney here. So let's say that you have a home that's worth, the tax term is called fair market value. And let's have it around $500,000, below average single family home price here in Hawaii. And of course, you probably had borrowed money from the bank. So you have a mortgage. So after a few years, let's say the mortgage is paid down to $300,000. And if you sell your home, the mortgage has to be paid off. And then the remainder is what you pocket before any selling expenses. So before you sell this property, right now, the net value you have in your home is not 500,000, but you got to reduce it by any mortgage you still owe. This remaining 200,000 is called the equity value. Again, basically what you're going to pocket if you sell your home. And over time, hopefully, the fair market value will increase. Just based on inflation, it should increase. So that's going to increase this equity you have here over time. And then every month, hopefully you're still making your mortgage payments and the principal balance here of your loan is going to go down. That's also going to increase the equity of your home. So over time, hopefully this equity gets larger and larger. This equity, though, is not the gain you have to report in your tax return. Yeah, not this gain we're going to calculate and tax it in chapter 11, our next chapter. So let's go through a formula to figure out the amount of gain or the amount of loss. So we'll start off with that fair market value again, but we'll call it this time sales price. And the sales price most times is going to be received in cash from the buyer. Probably the buyer has to go to their bank and borrow money and give it to you or give it to the escrow company that's going to handle all of the paperwork. It is possible that you still owe money on your mortgage, and if the buyer is willing to take over your loan and your bank gives the permission for the buyer to take over your loan, we call that a loan assumption. And that's just as good as cash being received, because if you receive just pure cash, you got to use that cash to pay off your loan anyway. Another situation would be instead of getting back cash, you get back some other property. Remember, you're giving up a property, but now here you're getting back in exchange some other property. So sometimes this type of transaction is called a sale, where you receive cash, or an exchange where you receive other property other than cash. Something that you may get back that's not common is maybe some type of service. Someone is providing a service when you give up this property. Again, all of this value here has to be added together to get the sales price, the total sales price. Now, from this sales price, we're going to subtract out selling expenses. Possibly, if you're dealing with real estate, the biggest selling expense would be the sales commission you have to pay the broker, the sales agent. Or maybe you have some type of documents that have to be drafted, contracts, deeds, transfer agreements, or maybe you're incurring some type of advertising cost to sell the property, or you're paying some type of, maybe it's a car you're selling, so you have to ship it to the buyer, and you're incurring that cost. All of these are called selling expenses that you subtract from the sales price, and the remainder is not the gain, but something called the amount realized. That's sales price minus selling expenses. And now you're going to subtract out something called adjusted basis. Most people would call this the cost, but we'll see cost is just one type of adjusted basis. And the remainder is now the gain. And the general rule is you pay taxes on gains. But again, we'll save the actual detail of calculating the tax for the next chapter, our chapter 11, which will be the last chapter of the semester. Or if the adjusted basis is larger than the amount realized, the difference is called a loss. The general rule is that losses are not deductible unless they're allowed by the tax law. The general rule for gain is gains are taxable unless specifically excluded, treated tax-free by the law. Okay, so that's the general rule, yeah? Gains are taxable, losses not deductible unless otherwise provided by the tax law. So this is what we're figuring out here in chapter 10. But the main focus, and again we'll save this for the second part 2 video, is to figure out this adjusted basis. Now let's talk about some terminology when we're dealing with property, when we're dealing with sales of property. So property can probably be classified, let's go to a new screen here, probably can be classified into 3 different categories. One type is called personal use. So for most people, this is their automobile. This is their furniture in their home, their clothing, stuff that you're not using for business, versus business use property. So here's the company automobile, the company delivery truck, the office building, the land that sits under the office building, the equipment inside of that building, the barn for a agricultural operation, a factory. All of the property there is business use. And there's one more category here called investments. Things like stocks, bonds, mutual fund, exchange traded funds, maybe limited partnership investments. Yeah? So you have to determine what type of property it is, one of these 3, when you calculate out the gain and the loss, and they'll be treated differently. Again, generally, any type of gain is going to be taxable. Any type of loss, let's talk about losses. If the loss is incurred when you sell your own personal use property, again, think of your personal car. The loss is not deductible. If you have, let's say, a delivery truck being sold and you incur a loss, The general rule is that the loss is deductible. If you have an investment like a stock and you sell it at a loss, the loss is generally deductible up subject to certain limitations. And we'll find out the limitations for this loss here and here to be deductible in the next chapter. But again, once you sell a personal use property at a loss, not deductible. Maybe the one exception would be if you have your property destroyed in a federally declared disaster, then maybe that loss maybe could be deductible, as we had learned back in maybe in chapter 5 for itemized deductions. Not common, but a possibility. Let's talk about another way of slicing and dicing property. One type of property is called tangible, things that you can physically touch. Another type is called intangible, stuff that has value but you cannot physically touch. So this would be again your automobile, your home, your clothing, uh, company car. Here would be stuff like investments, like here, that you cannot physically touch. Maybe you can touch the paperwork that represents that investment, but it's not tangible. Even cash. Cash represents some value on a piece of paper, but it's intangible value. If you talk about business intangible assets, we have stuff like copyrights and patents, leasehold interests, um, anything that you has value that you cannot physically touch. So let's talk about tangible property. Tangible property can be classified either as real estate or real property, like the land and the building sitting on the land, versus personal property. Now, this is not the same as personal use property that I mentioned at the beginning of this different categorizations here. Yeah. Again, this is stuff that's not business. Yeah. That's not investment. And then the personal down here is stuff other than real estate. Personal property not attached to the land. So we'll talk about selling real estate and selling personal property and figuring out the gain or the loss. Let's do that gain or loss calculation one more time again. Sales price minusing out the selling expenses will give us the amount realized. Then subtracting out the adjusted basis will give us either a gain if amount realized is bigger than adjusted basis, or loss, just the opposite. So now gains and losses can be either realized or unrealized. Don't confuse it with this realized here, yeah? An unrealized gain or loss is when you have not actually completed this sale yet. You haven't sold the property. It's a potential gain or potential loss. Just like that equity we saw at the beginning of this video lecture. You haven't sold it yet, but you have this built-in value. So the same thing is true here. If you haven't sold the property yet, you have an unrealized gain or unrealized loss. Now, when you do sell it, when you complete an exchange or sale, now you have a realized gain or a realized loss. Now, the question is whether that gain is taxable. The question is whether the loss is deductible. If the gain is think I might run out of space here. If the gain is taxable, you pay taxes on this gain. Another term we use is called the gain is recognized. Okay, recognized. If the gain is tax-free or postponed, tax deferred, we call that unrecognized. If it's recognized, that means you're going to report it on your tax return and you pay taxes on it. Unrecognized means you're either not going to report it on the return, or if you do report it on the return, it's still going to be tax-free. You don't pay taxes on it. Now, when you talk about losses, the losses can either be deductible or non-deductible. We like losses to be deductible. That means you're going to subtract it on your tax return and you get the benefit of that. So the loss is going to be recognized in this case. Or if you have a loss, you're economically worse off and you cannot deduct the loss, non-deductible, the loss is unrecognized. And if you remember, when you sell personal use property at a loss, the loss is not deductible. The loss is not recognized. You don't even report it at all on your tax return. Okay, so lots of different terminology here. There's realized or unrealized, just means whether you sold the property or not. Either you have a potential gain or potential loss if it's unrealized. And when you actually sell the property, now the gain or loss is realized. And then the question is whether the gain is going to be taxable or not, whether the loss is going to be deductible or not. If it is taxable, the gain is recognized. If the loss is deductible, the loss is recognized. So the best of both worlds would be untaxed gain and deductible losses. Okay, I know it gets a little confused here with all this different terminology, but the basics is trying to figure out this gain or loss here. And then we'll save the actual taxation or deductibility for the next chapter, chapter 11. Go ahead and continue into the part 2 video for this chapter 10, and we're going to focus on this adjusted basis amount.